You never cast a ballot for them. You won't see their names on election day. But right now, a small group of unelected officials has their hands on the main power switch of your financial life. When you apply for a mortgage, swipe a credit card for groceries, or look for a new job, the interest rates you pay and the economic opportunities available to you are dictated directly by their decisions. Understanding the Federal Reserve is the only way to know who actually pulls the primary levers controlling your personal wealth and future. In the early 1900s, keeping your money in a bank was a gamble. Banks didn't hold enough cash to cover all their deposits. If an economic scare started, fearful crowds rushed the doors to withdraw their savings, causing the bank to fail, which only sparked more panic. During a massive bank run in 1907, the entire United States financial system nearly collapsed. It was only saved because one tremendously wealthy banker, J.P. Morgan, stepped in to personally bail out the system with his own money. Business and political leaders quickly realized that a growing nation could no longer rely on the charity of billionaires. They needed a centralized system to manage the cash supply, a permanent financial chaperone. This map shows how that central banking system was originally designed in 1913. Because politicians feared handing too much authority to Washington or New York, the Federal Reserve was split into 12 separate regional banks spread across the country. The idea was that each region would handle its own policy. But when the Great Depression hit, no one was actually in charge. The decentralized banks failed to inject enough cash into the economy, turning a crisis into a decade-long catastrophe. To fix this fatal flaw, Congress overhauled the system in 1935. They put a Washington-based board of governors in charge, leading a centralized group called the Federal Open Market Committee, or FOMC. Concentrating the power into a single room allowed this committee to finally wield their most potent tool for steering the economy, setting the baseline interest rates for the entire country. By 1978, Congress gave the Fed two specific jobs, represented by this scale: keep prices stable on one side and maximize employment on the other. It's called the dual mandate, and those two goals constantly conflict. During the 1970s, a mix of bad luck and bad policy sent consumer prices spiraling out of control, eventually hitting an inflation rate of nearly 15%. In 1979, Fed Chairman Paul Volcker took drastic action to stop the spiral. He intentionally spiked interest rates to nearly 20%. When the Fed sets rates that high, it costs businesses and consumers a fortune to borrow money. People stop buying homes and cars, and companies halt expansions. Prices finally stop rising, but thousands of people lose their jobs. The medicine was brutal. Unemployment shot above 10%. Angry homebuilders mailed unsold keys and literal 2x4s to the Fed's headquarters in protest. Volcker proved this economic weapon works, but the cost is paid by the working class. The Fed's playbook remained mostly the same until the 2008 financial crash. This time, even dropping interest rates to near zero wasn't enough to stop the bleeding. Chairman Ben Bernanke had to go further. He initiated emergency programs, loaning huge sums of cash directly to non-banks and buying up mortgage securities to keep credit flowing through the system. When the COVID lockdowns hit in 2020, the Fed deployed that same strategy, effectively creating trillions of dollars out of thin air to keep the financial markets liquid. By repeatedly taking these radical steps to buy the economy out of trouble, the Fed evolved from a simple background bank into the primary life support system for the entire American economy. Which raises a central question. Why would elected officials in Congress and the White House willingly hand over the steering wheel of the U.S. economy to a small group of appointees? History gives us the answer. In the early 1970s, President Richard Nixon successfully pressured Fed Chair Arthur Burns to keep interest rates artificially low right before the 1972 election, prioritizing short-term votes over long-term stability. Good economics is often terrible politics. By keeping the central bank independent, Congress gets a permanent shield. When the economy needs painful medicine, elected leaders can let the Fed administer it and take the public outrage. Today, through decades of crises and government gridlock, the Federal Reserve is frequently the only institution capable of moving fast enough to intervene when the financial system breaks down. Every adjustment made in that boardroom filters down to your reality, setting the cost of your groceries, the interest on your car loan, and the security of your paycheck. You won't see their names on a ballot, but their decisions provide the baseline for your financial future. Watching the Fed is the most direct way to track the massive forces shaping your own money.